Imagine you're running a business where the fundamental laws of gravity just change overnight. I'm not talking about a bad quarter. I mean a year where the entire economic operating system gets a total rewrite. Inflation starts at these, terrifying highs, then drops like a stone. The government, your biggest, safest customer for decades, suddenly closes its wallet and just says, hey, we don't need your money anymore.
Uh-oh.
And on top of all that chaos, the economy itself shrinks by 2.4%.
It's the business equivalent of trying to change the tires on a Formula One car while it's still moving at 200 miles per hour. That is the backdrop for the company we're looking at today.
And we're not talking about some nimble little tech startup here. We are diving into the performance of a massive legacy institution, the bank with the largest branch network in the country. We're talking 558 points of attention, over 6 million customers. In a lot of ways, their 2024 report is a proxy for the entire national economy. But looking at these numbers, I have to be honest, the first thing I see, it looks like a disaster.
You're looking at the bottom line.
I am. Net income for the year was roughly $325,132 million. Now, to the uninitiated, that sounds like a lot, but compared to the previous year, that is a drop of 74%.
Mm-hmm.
If I'm an investor holding this stock, I'm not looking at the context, I'm looking for the exit. Why shouldn't I be panicking?
Because you're comparing a detox year to a year on steroids. 2023 was a financial hallucination.
A hallucination.
The bank posted record profits back then, but a huge chunk of that was easy money generated by inflation and currency devaluation. They were holding assets that just inflated in value on paper. It wasn't really derived from the core business of banking. It was accounting gains.
So 2023 was a sugar rush.
Exactly. It was massive sugar rush. 2024 was the diet.
Yeah.
The government applied this shock therapy to the economy. Inflation cooled down, and those easy accounting gains just evaporated.
Yeah.
That 74% drop. That's just the inflationary noise being stripped away. What you are left with is the actual, organic performance of the business.
Okay, so if we strip away the noise, what does the health of the patient actually look like?
Surprisingly robust. I mean, despite the recession, they posted a return on equity of 7.5%.
7.5%.
Now, in a boom year, 7.5% it's boring. But in a year where the economy shrank by 2.4%, that 7.5% is pure muscle. It proves the core business works without the inflationary steroids.
Okay.
Plus, they are sitting on really high liquidity, about 79%, and their capital integration is nearly 300% above what regulators require.
Meaning they have a fortress balance sheet.
Correct. And they're proposing a dividend of roughly $469 per share. Companies that are scared about their future don't usually hand out cash to shareholders.
Fair enough.
Yeah.
But let's talk about how they actually made that money, because the game completely changed. You mentioned the government stopped borrowing. That sounds like a technical detail, but for a bank in this market, that's an existential crisis, isn't it?
It's the single biggest strategic pivot of the decade. We call it the macro-prudential shift. For years, banks here practiced what I'd call lazy banking.
A lazy bank.
You take deposits from customers, you lend that money to the government via bonds, and you collect a nice, risk-free check. It was comfortable.
And then the government achieved a fiscal surplus and just turned off the tap.
Overnight, the company woke up with a massive pile of cash and no government to lend it to.
Right.
They had to pivot from financing the public sector to actually lending to the private sector, real people and real businesses.
Sink or swim time.
And the data shows they swam fast. They didn't just inch toward the private sector, they sprinted. Private sector loans grew by 45%.
45%. That is a massive jump. Where do they even find the borrowers in a recession?
A mix of places. Personal loans grew about 130% across the whole system. But the real headline for me is the return of mortgage credits. They launched mortgages with terms up to 20 years.
20 years. That kind of long-term thinking has been extinct in this market for a long time.
Yeah.
It suggests they're betting on long-term stability.
It does. It's a huge signal of normalization. But here's the catch. Growing your loan book by 45% during a recession is really risky.
Sure.
Remember, supermarket sales were down almost 17%. People had less money. Usually when you lend aggressively in a downturn, you end up with a lot of bad debt.
That was my next question. Did they just throw money out the door to replace the government revenue, or were they actually being careful?
The numbers suggest they were incredibly careful. Their non-performing loan ratio, so the percentage of loans that go bad, stayed at just 1.3%.
1.3% is impressive, even in a good economy.
It is. It validates their risk models. It shows they can grow the portfolio without sacrificing quality, even when their customers are feeling the pinch.
So they navigated the government cutting them off. They survived the recession without bad debts blowing up. But they decided that wasn't enough of a challenge, so they also decided to merge with another bank at the same time.
Right, because why make things easy for yourself? They were in the middle of integrating BMA, which was a major international subsidiary they'd acquired.
And mergers are notoriously where value goes to die, right?
Oh, yeah. You have different IT systems, different corporate cultures, branches literally across the street from each other. Usually these things drag on for years and just distract everyone from the actual business.
Okay.
But they pulled off what they called a 9-month sprint. They completed the full operational merger in under a year.
9 months? That seems unbelievably fast for a bank.
It's lightning speed. And the scale was huge. We're talking about migrating 1.3 million savings accounts and 110,000 checking accounts. They integrated 1,292 new collaborators into the company.
Collaborators.
That's their term for employees, yeah. But the key here isn't just the speed, it's the strategic fit. By acquiring BMA, they didn't just get bigger, they balanced their map.
What do you mean by that?
Historically, the company was a powerhouse in the interior of the country, the provinces. BMA was strong in the capital, the metropolitan area.
Ah, I see. So now they have the whole board covered. 6 million customers total.
Precisely. It was a major play for scale.
But here's the thing about scale. Holding on to 6 million customers is way harder than getting them, especially now with fintechs and digital wallets nipping at your heels. You can't just rely on having a branch on the corner anymore.
That's absolutely true. Physical presence isn't the mode it used to be.
Which brings me to the part of the report that I think is their secret weapon. They call it macro gobiernos digitales. It sounds kind of boring, but when I dug into it, it looked like they were trying to be more than just a bank.
You're spot on. This is their GovTech strategy. They aren't just holding a municipality's money, they're providing the digital infrastructure for the government to interact with its citizens.
Explain that. What does that actually look like on the ground?
Okay, think about the app Ciudadana or the digital collection systems they rolled out for municipalities like Salta or San Miguel de Tucumán. If you live there and you need to pay a parking ticket or your local taxes or even schedule a doctor's appointment at a public clinic,
I'm using their technology to do it.
you're using the company's tech. Exactly. It creates this very sticky relationship. I get it. If you run the operating system for a city's revenue collection, that city is very unlikely to switch banks just because a competitor offers a slightly better interest rate.
It's the infrastructure mode. They aren't just a lender, they're a utility.
And that diversifies their revenue. It's a very smart hedge against the volatility of traditional lending.
Speaking of infrastructure and utilities, let's look at the ESG report. Environmental, social, and governance. Usually bank ESG reports are full of, generic photos of wind turbines and promises to go paperless. Was there anything in here that actually impacted the business model?
There was one initiative that really stood out to me because it addresses a specific local pain point. They've been installing solar panels on ATMs in remote areas.
Solar-powered ATMs.
Yes. In places like La Poma or Dos Hermanas, these are remote locations where the electrical grid can be unstable.
So if the power goes out.
The town loses access to cash. By installing solar panels, they ensure the ATM stays online.
That's actually a brilliant example of environmental meeting social. It's not just about carbon footprints, it's about resilience for the customer.
Exactly. I mean, on the broader environmental front, they got ISO 14001 certification for their headquarters and neutralized 27 tons of CO2 equivalent. But the solar ATM thing is the real highlight for me because it speaks to their core strategy of serving the DUP interior of the country.
Okay, let's look at the S in ESG, the social aspect. You mentioned they integrated over 1,000 new employees. How is the culture holding up?
Well, they ranked number 7 in the Great Place to Work list, which is up 5 spots. So that suggests the merger didn't destroy morale, which is a common risk.
Clear.
However, there is a data point in the diversity section that we really need to talk about.
Let me guess. The workforce is diverse, but the boardroom isn't.
You nailed it. If you look at the total workforce, it's 41.8% female. Pretty balanced.
Okay.
But when you look at Alta Gerencia senior management, that number drops to 12.5%.
Ouch. That is a steep drop-off from over 40% to 12%.
It is. It shows a significant glass ceiling. To their credit, they published the number clearly in the report, so they aren't hiding it. But that structural inequality at the top is a risk factor. Diverse leadership teams tend to make better decisions, especially in volatile markets.
Yeah, that's a fair point. And finally, governance. Anything there that keeps the ship steady.
The key takeaway is the Sarbanes-Oxley, or SOX, recertification. Because they have exposure to international markets, they have to comply with really rigorous U.S. standards for it is, and their objective is to ride that wave. They plan to further expand that private credit portfolio. They expect inflation to stabilize somewhere between 20 and 40% annually.
Right.
And as inflation drops, credit becomes affordable again for regular people. They want to be the engine of that lending boom.
So sell more loans. Got it. What else?
They're doubling down on customer experience with a model they call close the loop.
Close the loop. Sounds a bit like corporate speak. What does it actually mean?
It's actually pretty practical. Right
Yeah.
now, they get feedback from branches or call centers. They want to expand that feedback system to all their digital channels in real time.
So if a customer hits a pain point on the app,
The bank wants to know immediately and fix it. It's about moving from just processing transactions to really managing the relationship.
okay. And on the ESG front, any big goals there?
They're moving to something called double materiality for their 2025 targets.
Okay, hold on. Double materiality sounds like you just won consulting bingo. Translate that for me.
Fair enough. It's actually a crucial distinction. Single materiality is, how does the world affect my bank? Climate change risk, regulation.
Okay.
Double materiality asks the reverse question, how does my bank affect the world?
So it's not just, will a flood destroy our ATM? It's, are we funding the projects that cause the floods?
Exactly that. It forces them to set targets on their actual impact, not just their financial risk. They haven't published the final numbers yet, but just moving to that standard is a signal they're taking this stuff seriously.
Okay, let's wrap this up. Let's bring it home for our listeners. We've covered the financials, the merger, the tech, the future. If you had to distill this entire report into 3 key insights, what are they?
Okay, insight number 1 has to be agility as a survival skill. This is a massive legacy institution that managed to swap its primary revenue source from government debt to private lending in 12 months.
While merging with a competitor.
Exactly. It just disproves that old idea the big banks can't dance.
That's a big one. My takeaway is the infrastructure mode. By digitizing the municipalities through their GovTech initiative, they've made themselves almost unfireable.
Yeah.
They aren't just a bank, they're a utility. That is how you protect yourself against fintech disruption.
That's a great point. And my final insight would be the reality check. The easy money from inflation is gone. 2024 proved they can survive the detox. But 2025, it's going to be a street fight for every single unit of profit. They have the scale, but now they have to prove they can win on service and efficiency, not just on asset appreciation.
It brings up the ultimate question for next year then. Can a bank that got used to making money from financial instability learn to thrive in a normal economy?
That is the multi-million question. They have the tools, they have the scale, now they just have to execute.
Well, it's certainly going to be a fascinating year to watch. Thank you so much for walking us through the numbers and the strategy.
My pleasure. It's always fascinating to see how the big players adapt.
And thank you to everyone listening. If you enjoyed this deep dive, make sure you're subscribed so you don't miss our next one. We'll see you then.